Can you hear me? It's a stupid question. If you can't hear me, you can't answer it. Welcome back from the coffee break. My name is Pehr Wissén. I work here at the Swedish House of Finance, and I will moderate this session. We are going to do basically two things. First, we're going to present to you 3 case studies. Studies of 2 Swedish and 1 US firm that is successfully working with AI in their business. And after those 10-minute presentations, we will bring the 3 presenters up on stage together with Brian Kelly for a panel discussion. And we want to discuss sort of how will all of this we've heard about, AI and machine learning, how might that affect the financial sector? Will it be a total, will nothing ever be the same as before? Or are these better tools, but it will basically be the same industry as it has always been? Those kinds of questions. And I strongly encourage you to take the opportunity to ask whatever questions you may have. All priorities goes to questions from you on whatever you have that the panel might answer. And our 3 presenters, I think they appear on pictures behind me, is Kaminski, Chief Research Strategist at AlphaSimplex. I will introduce you a little bit more thoroughly when you come up on stage. Sven Törnkvist, Head of AQT Digital, and Svante Bergström, co-founder of Lynx Asset Management. And you all successfully use AI in your respective businesses. And as I said, after that, Brian Kelly will join us on stage. Katie will start, followed by Svante and Sven. And if there are short questions on the cases, you may ask them right after. It's just sort of clarifying questions. Otherwise, we save the discussion for the panel. And questions we might ask is, as I said, is this revolutionary or evolutionary? Will AI lower costs, or will it create new products? Sort of what kinds of changes might we expect? Okay, so our first presenter is Katie Kaminski. Katie is Chief Research Strategist, as I said, as one portfolio manager at AlphaSimplex Group. She has a PhD from MIT. She has written multiple industry white papers, co-authored a book on trend following. She's on the list of the top leading women in hedge funds, and I can go on and on and on, but she's also a great friend of ours here at the Swedish House of Finance. She has worked here for many years and taught here, speaks fluent Swedish. We are so happy to have you back, Katie. Please, the floor is yours.
Wow. Thank you, Pehr. It's so nice to be here, to be back in Stockholm. Haven't been here for quite a while. I moved about 8 years ago, so coming back and seeing some familiar faces, really exciting. Today I'm going to talk just a little bit about how we think about machine learning and some of the experience as someone who's managing money in the industry. Myself personally, I've also been affiliated with the MIT Laboratory for Financial Engineering, so I've also done some research in machine learning as well with my thesis advisor, Professor Andrew Lowe. And so maybe it can give a little bit of perspective of different applications versus the trading perspective versus, say, other applications where you have to think about where machine learning and AI makes sense. So just to start, I want to just move to what AlphaSimplex is, so you know a little bit about who we are. AlphaSimplex is a firm that was founded by Professor Andrew Lowe, who's now actually moved much more into biotech. But the whole entire premise of the strategies we trade is to think about adaptive markets, to think about the idea that markets are ever changing, and we need to develop systematic approaches so that we can change with the markets and provide returns for our investors. So our entire approach is really about how do we create systematic models that will actually benefit from markets changing over time in such that we can actually provide interesting returns to institutional and retail investors. So we're based in Boston, and we manage roughly $9.4 billion in the futures markets. So one of the core cornerstones of our approach, as I said, was to apply models systematically that find opportunities in markets as they change. Since the beginning, we've been applying about 40% of our risks to what we call adaptive models. So in that bucket, it's a range of different machine learning techniques. We're trying to determine how to trade the trends that we see across global markets. And this is actually extremely difficult for several reasons. If you imagine thinking about a backtest, for me, as somebody who trades the markets on a day-to-day basis, my out of sample is today. It's not rolling windows, it's today. And thus, you have to really think very clearly about what you're willing to actually put at risk going forward. So I think I just want to make one more point here. There's a very good paper by Andrew Lo that's called Warning, Physics Envy May Be Hazardous to Your Wealth. And in this particular paper, he talks about this idea of irreducible uncertainty versus reducible uncertainty. And so I think one of the challenges that we can have all the tools in the world, but we need to find situations where we're actually able to reduce that uncertainty in a way that actually makes sense on a walk-forward basis. So in that sense, when you're talking about trading, you have to think very clearly about what actually can be traded going forward versus other applications. So let's give a simple example of demographics, right? So we also had a research paper where we looked at panic selling. So in this, we used one of the largest brokerage databases out there to examine who panic sold in financial markets. In that case, think about it, demographics behavior is pretty persistent. So if you have more data, you can actually really do a good job at explaining this. So this paper was very, very controversial because it came out and said demographics in the US, that if you were older, married, male, and you said that you had good investment experience, you're actually more likely to panic sell. So that was very catchy. The news reporters loved it. Anyways, so there's a good example of if you have demographics, those don't change, so you can actually use more data and better forecasts to actually determine relationships in the data. On the other hand, when you're thinking about trading the markets, you have to think a little bit more about, and I think this goes back to already what Brian was talking about earlier, is what are the trade-offs between the two of these? So you have an overspecified model and sort of a simplified model. So in practice for us, what we're trying to do, let me just explain this graph. This would be my trend signal. So if it's up, then I would be buying. If it's down, then I would be selling. And this is the data that I can observe to try and fit that particular signal. So should I be long or short the US 10-year, as an example? Now, what we try to do in practice is try to think about explaining this to our clients in the following way. Classic approaches, like we talked about earlier, have a linear signal strength relative to data that you bring in. So you want to use learning techniques to try and learn, in sense, the response curve of markets to your signal. So what is your signal as a function of the data that you're bringing in? So if we look at this picture right here, and let's just assume this is the US 10-year, so interest rate contracts. What this would show is that if I learned to trade like this, when my data is very positive, then I'm actually going to buy more than the linear model. It's going to slow down, and then I'm going to buy less than the linear model on the downside. So these models actually work very well for markets that tend to trade at different frequencies. So if you use an example of the US 10-year note, the US 10-year note tends to accelerate at certain points and decelerate at different frequencies. So with learning models, what we're trying to do is, in some sense, create a response curve, a nonlinear response curve of data to the market so that we can trade the market. There's one little trick to this that I think is really important as well. In the last 2 or 3 years, and this is something I've heard from a lot of institutional investors, a lot of machine learning techniques have struggled in the last 2 to 3 years because there's been a structural shift. And this is about that uncertainty. So what do I mean by that? If this is your signal for trading bonds, this year, what would you do? Bonds are down, you'd be under-allocated to that trend because you learned, as you should have, that bonds aren't good. That bonds, are always good. They never go down, right? So let me just try this in this audience for a second. How many of you thought rates would go up this year? Most people. How many of you were short bonds? Me and Svante. Okay, good. Okay, so the point is that you can have bias, just like we have bias as individuals, you can have bias in your machine learning models as well. So that's something that we always have to think about, is whether or not this response curve is then implicitly creating a bias should the world change. So just to kind of give an idea of how this works, is you can use different techniques. This is an example of a random forest type model, where you use different data, you apply those to create filters, and that filter creates a response function, which then generates a signal. So the goal is to use all that data in such a way so that you still have an interpretable forecast, but at the same time, you're allowing your system to have nonlinear features. So this is just, I wanted to give this as a simple example of how we think about trading the markets. So just one last point on that before I finish. I think this year has been a very interesting year for us in the systematic space. The biggest trade this year has been short bonds. And if you think about it from a historical perspective, your entire backtest said, don't do it. But this year, it worked. That's where you have to really think, how do you make sure that those models can change? That they're not stuck in the past. So I think that's one of the key things we spend a lot of time thinking about. We get that question from investors all the time, making sure that we actually are willing to remove the bias in our systems. So thank you.
Svante Bergström is CEO and one of the founding fathers of Lynx Asset Management, a hedge fund located in Stockholm. Lynx was founded in 1991, and you utilize machine learning techniques. Please, Svante, floor is yours.
Thanks so much. I think founding father sounds good. I'll start using that. So just to give you some background on me and put me in the context of this conference, is that I worked as a stockbroker back in the mid-'80s at the Stockholm Stock Exchange. I've always had a bias towards quant strategy. So I did arbitrage between the investment companies and the underlying stocks, and I traded lottery bonds, premieobligationer against the forwards and stuff. But it was, it was not machine learning. It was back in the days before Excel, basically. So, and then I moved to Nordbanken, Nordea, and met my two becoming founding partners, Jonas Bengtsson and Martin Sandqvist, and they are engineers. So, and they are the smart guys. That's kind of how we divide things in the company. So I run the company. I am on the board on the investment committee. I allocate risk to machine learning models, but I'm not hands-on. I mean, I went to the Stockholm School of Economics, and we learn to do some maths, but not in the degree that you may need nowadays. So my focus is to hire very smart people. Some of them are here today, and they do the nitty-gritty stuff. So I will focus here on kind of how to allocate risk to machine learning models, how we see it from a business case. But I will not be able to give you kind of the technical answers to what we do. Okay, so Lynx then. What about the firm? Is this? Yeah, there you go, okay. So we are 100% systematic. We're pretty much like AlphaSimplex, so that's a close competitor or fellow in the market. We're highly correlated and do a lot of things that are similar. We trade long and short, so we have no bias to be long in markets. And we trade only future markets. We don't do any single stocks at all, so it's purely futures, but in different sectors, both fixed income, commodities, and FX and stock indices. And we trade roughly 100 different markets. And the thing that we, compared to traditional funds, we allocate risk. So we don't allocate capital at all. I mean, since futures, you put in a margin and then you can buy high leverage positions. So that's the way we do it. We don't care that much about the capital that we have under management. It's a risk game. And in terms of the size of the company, we are 8 billion US. So we are one of the probably top 5 trend-following CTAs in the world. And if you look at the clients that we have a heavy tilt towards big institutions, international institutions. Not that many Swedish clients, actually, but more the clients that go more for risk mitigation strategies. They put this in their portfolios to have in difficult market environments, stressed markets, crisis alpha. And Katie has written a good book on the kind of the case for this kind of investments in the portfolio. And we have a team of 80 people in Stockholm. We have a small New York office as well, but most of the people are in Stockholm. I would say 30-ish people are researchers. And then we have 30 people working with system development and trading. So it's heavy tilted towards research and building the models that we use. So going to how we define machine learning, and because that is not self-explaining, I would say. We look at it as when models that learn and improve from data, and also that they adapt and change over time when new data come available. And that's kind of blurry when you compare it with the other models that we have in the portfolio. We have totally like between 40 and 50 models in the portfolio where we allocate risk to. And I would say a third of them, maybe 10 to 15 models are machine learning models, and they adapt over time. And then we have more linear models as well on top of that. And also in terms of risk, I would say 30% of the risk is in machine learning. So how do we use machine learning, and why would you use it? I would say that if you back when we started, we had more traditional models that are more linear, and then it was much easier to build models when they weren't that complex. But when you try to look at a lot of different markets at the same time in a multivariate way, and also adapt over time, then machine learning is something that is really, really good. So especially the adaptiveness of these, where since we know that markets change over time, we know that the ML models helps us to stay in tune with market developments. And another question would be that, are they better than our traditional models? Do they deliver higher Sharpe ratio, or do you find the kind of holy grail here? And I would argue that probably not. In our portfolio, they have delivered slightly higher Sharpe ratio, and that's good. But if you look at the industry as a whole, there are a few managers that are, totally focused on machine learning models in their portfolios, and they don't, over-deliver compared to us, for example. So it's not kind of an easy thing just to say that machine learning will improve your returns. And there are a couple of different scenarios where machine learning struggle, and one would be like we had in the COVID crisis, the pandemic, where you get totally new data coming in, and markets get stressed, and the machine learning models, they haven't seen this before, so then they struggle and lose money, probably more money than traditional models in that environment. And also, in very strongly trending markets, when markets are stressed, then normally the simpler the better model, basically. You don't need fancy stuff then. You just need simple trend following, and they tend to perform best in that environment. Okay, so there are a lot of challenges with machine learning, and I will not dig into all of this, but I would say that the one problem we have in the financial sector is that we have a very low signal-to-noise ratio compared to other industries when they use machine learning. So that's a big challenge. Also, the data is not synchronized. So, for example, you have different time zones that you have to take into account when you build these models. Also, if you have macro data that we use in some models, you need to take into account if it's point-in-time data, if it is revised over time, and so on. So that's a challenge. Also, the trading cost, implementation cost is something that, if you're new in the industry, that's a big challenge to really understand how expensive it can be to execute your trades. Especially if you have a model that adapts over time and change, then you have to really know how to calculate those costs over time. But we use machine learning when it comes to execution. We use a lot of machine learning in the execution process when we use the execution algos. But then we already know what to do in the markets, and then we don't have any trading costs. Basically, we just try to improve the execution. But the biggest challenge, I would say, with machine learning compared to traditional models is really that as long as you make money, and then everybody's happy and you trust your models. But as soon as you start to lose money and you get into a drawdown, then if you have a very complex model and really don't understand why that model gives the signals that you get, then that's a challenge. And that's, I would say, that's the biggest challenge with machine learning for us. It's a black box to some extent. To some extent, you can find, reasons for the positions, but the more complex model, the harder, I would say. And that's why I think I wouldn't really like a model that is totally, too many parameters and too complicated. But I really like the presentation, but it's a challenging thing to implement. Okay, just a couple of words on our journey then in machine learning. We started, one of the managers, the founding partners, Jonas Bengtsson, started playing with neural networks back in 1994. We bought floppy disks from the US, the software, but the computer power and the data we had and so on, it wasn't really useful back then to get anything that could be useful for us. So it was in 2009 when we hired our first ML expert, PhD from Google, and he started to build models for us. And since 2011, we have implemented a handful of models, or a dozen of different features and different ways we have built those models, partly depending on who has built the models. We have a big research team, as I said, and over time we have looked at different type of ways to build these models. So we're really bullish about this. I think a lot of data comes available. We also look at alternative data. Sometimes it's encouraging. Sometimes you don't find anything, but it's really nice to play around with it. I think it's being a big manager and have a lot of resources is nice, because this is an investment game. You have to, buy a lot of computers and servers and pay high salaries to people digging into these data and try to build new models. But I think it's really a very nice future we have in front of us. Thank you so much.
Okay, Sven Törnkvist, head of EQT Digital. You have a master from the Stockholm School of Economics, I noted. You have worked for Google in Sweden, and you have 7 years almost experience at EQT and a long experience of working with technology. And we're very happy to have you here.
Great to be here. Thank you. So yeah, I do my best to disguise the fact that I'm actually an SSE alum by, I work with data scientists and data engineers, so I have to wear sneakers. It's part of my job. Here to present Motherbrain, and now shifting the perspective on the private equity markets a bit. For those of you, I'm not going to introduce EQT. I assume it's well understood what we do. We're a sizable player, currently the third largest private equity house in the world. So we've grown significantly over the past years. A reason for that, or a big part of that is our digital enablement, so not limited to Motherbrain, but also to our investment on the EQT platform. So long before digital transformation was the term, we were actually investing in what are the most modern tools and how can we make sure that our team are enabled. So when something like the pandemic hit, we were quite resilient. We were able to actually navigate through that and act on opportunities when people were maybe a little bit less inclined to do so. Motherbrain. So Motherbrain is a sizable team. It's a startup within EQT, and we've treated it as such. We insulated it and let it grow. These guys and girls, they are not natural immigrants to private equity, right? So you actually, in fact, we lead with the brand Motherbrain, not EQT, because that's a repellent, whereas Motherbrain, if you're a data engineer or data scientist in Europe, you've heard of it, and you might be attracted to it. As with any startup, we're built on the most modern tools and technologies. Even a young company like or startup like Motherbrain has actually gone through a few generational shifts and thrown out technology that is not cutting edge anymore to adopt new platforms. We're quite proud of the third image here to the right. It's actually, we're the only alternative investment firm in the world who has been published in one of the most prestigious AI conferences. So there's real deep science behind what we're doing. The other companies typically here are Alibaba, Google, and those guys. But what is it then? What do we do? Our approach is a very integrated one, right? So we don't, as many companies who invest in machine learning, I think go wrong a little bit. You hire really brilliant people and you put them in the basement and treat them as code monkeys. That's not what we do. We have a very integrated approach in many ways, right? So in order to have private equity investment professionals adopt the tool, it's really important to think about things like how do you get it in front of their eyes, right? So if it's hard to log in, if it's lots of friction in using the tool, they're not going to get there. But if you make it really sexy, it looks good, and it's easy, web interface and all that, you still have to have some form of active decision to go into it. And the way we cracked this was actually to merge deal management software or think CRM. So this is a basic tool for any investment professionals in their day-to-day work. Everyone goes into the tool on every level, right? Partner or director or associate or analyst, everyone touches these tools. Some are more reading data and others are also writing data. But this is how we make use of it, because we can be super smart and have all the data in the world, but if that data is not put in front of the right pair of eyeballs, it's not actionable. So we thought very much about that. Also, physically, this manifests itself that I'm actually not very differently dressed from most of my investment professional counterparts in EQT. You can see very, over 6 years how the cultures had merged between digital folks and the investment professionals. So most of us actually dress. I'm slightly overdressed if you compare to how a data engineer in the team dresses. I look like an investment professional, basically. But also in our offices, we have the data scientists, the data engineers, and the full stack developers sitting next to their counterparts in the investment professional. So there are no silos whatsoever. But it's very, if you come up and visit the EQT on Regeringsgatan, you'll see how data scientists and investment professionals working side by side. And that is crucial, because otherwise these guys will go in and dive into a problem maybe not worth solving. Maybe interesting for a data scientist, but not that worthwhile for EQT as a firm. And similar to, or rather I should say, a little bit, the challenge in private markets is, of course, that data is a lot less structured. It's a lot less real time. We're dealing with private companies, and in Europe, for the most part, there's good availability. We can get financial data easily. In the US, it's a very different ballgame. Private companies are just that, private. And Asia is a mixed bag, you could say. But clearly, if there's not one single data source, we have to look at many data sources in order to apply machine learning and get something out of it. So clearly, people is one element. Founders, individuals, we use our Motherbrain tool to actually do senior recruitment, finding boards, advisors, etc. Track certain types of founders is really interesting for us. Companies' financial metrics, that we buy a lot of data. Most of that is third-party data. But then what's really cool is that we also use news. So for instance, anyone in private equity at any given time will be working on 2-3 deals, 1 or 2 portfolio companies, and will at the same time be responsible for monitoring maybe 80 listed companies or private companies, right? And there's of course, that's, you don't do that. You don't go through 80 companies every week and look, is something happening? Rather, you want that data to come to you. So we've set up our algorithm so that, when a CXO is leaving, or there's a transaction going on, M&A, or there's something drastic happening to the share price, or other news that we find are interesting, we can calibrate those, and then this is a trigger for me to go and look at that specific company. Is something happening? Is this a trigger for an opportunity? In our growth and ventures business, we also look at social data. This can give us an early warning where Motherbrain will, any given day, Motherbrain will give us about 30 signals. Here's an interesting startup you should look at. And it uses a combination of everything. Might be app downloads, or social media mentions on Twitter, or Google queries. There's something happening. This trend is not linear anymore. It's starting to explode. Then we get an early warning signal. Go look at this company. It could be interesting. And that gives us about a 6 months advantage. So we can spot, our radar is better than most venture capital's VC's radar, because we get an early warning signal. We can target the company. We can build conviction. We can establish relationships with the founder team and potentially act on that as an opportunity. And sourcing is the primary use case. Not the only, but it's the one big proven use case that has paid for this entire team, in spades. So what you see here are a few examples of the ultimate score that we use, and something has happened. So it's an aggregate number of all the things I mentioned, and many other signals aggregated in one big ultimate score, telling you something, right? There's an absolute number to it, and then of course there's the dynamics behind it. Something is happening here. Go look at this company. It could be an interesting opportunity. This is what it looks like in where Motherbrain was born, in our ventures team. We've so far done 15 algorithmically sourced deals where we're an investor. One of those is an exit, and 3 are deemed unicorns. So this is, astoundingly good results. So we're super happy about what MotherBrain could do. And you know, you'll find we might have done that deal anyway. Yes, maybe. But if we didn't have that head start 6 months, then you know, what are the likelihood of us actually coming in and winning that deal? A lot less, right? So you know, we always discuss how much should we attribute to MotherBrain. There's a lot more companies that we could attribute to MotherBrain. These are the ones where unequivocally we wouldn't have done this. This would not have happened without MotherBrain. So these are the ones we put on slides, but then there's a lot where you could say MotherBrain assisted deals that we've done. And then what we're super excited about now, and probably more excited now than we were only 6 months ago, is the add-on opportunity. And that's twofold, right? So any given, you know, the PE game, it's rolling up companies. We can come in you know, on a very early stage, before we invest bankers or consultant time or anything, we can build, are there add-on opportunities here? And boom, get a long list of add-on opportunities. That's bread and butter in private equity, and we can just produce that list very, very quickly and at zero cost. And the other aspect of add-ons are digital add-ons, where we actually look to accelerate digital transformation of traditional companies. Think Anticimex with digital startups, right? So we buy digital startups that can, in some way, technology or go-to-market or talent aspects, whatever it might be, accelerate the digital transformation of that said traditional private equity investment and make it a lot better. And of course, given how the markets have developed, this is a much more actionable and attractive opportunity now, as valuations have come down drastically over the past 6 months, and we are super excited about that. I think I will stop there. Over to you, Pehr.
Thank you. Well, Brian, let's start. We heard Sara Örvall this morning showing how the use of AI was growing rapidly or almost explosively in all kinds of the economy. Is this technology, is it a revolution or is it evolution? I've heard you use those terms before, and I like them.
Right.
It's a sort of nice way of thinking about it.
Right. No, it's a good question. I'm going to answer this from the perspective of an asset manager like AQR, where I think it's important to recognize the type of business that a lot of asset managers are in, which is a high AUM, relatively low frequency forecasting business. Right? So if you think about that as the problem that we're trying to solve, you know, the role for machine learning is highly specialized. It's a small data problem because you can't have a lot of turnover, right? Turnover dictates the horizon at which you're forecasting, and that dictates the number of observations you have in a time series setting. So when I think about the asset management industry, I want to sort of focus on that because I think market making and HFT, those are sort of different animals. And in this context, I think I'd be very careful. I mean, I sort of take the other stance, which is I like to think about ML as a very natural evolutionary development in the asset management industry. So the types of things that I talked about this morning, the types of things that we're doing now, where we're trying to genuinely use complex models, even for these low frequency prediction problems, this is, I like to think of it as cutting edge, but there was a process to get here, and it wasn't a short process, right? So if you go back to sort of the foundation of the quant industry, we're trying to do what ML is fundamentally trying to do, which is use data, use technology, put them together, build informed investment decisions. And over time, as tools have improved, as computation has improved, those tools like immediately get put to use, right? So if it's 20 years ago, quant investing becoming more estimation driven, even if it's just using regression models, I mean, that's a big advancement that was the underpinning for current advancements. And so I do think about this as fundamentally an evolutionary shift. We need to recognize that we're never going to transition into the types of environments where ML has really been revolutionary, because those are all fundamentally large data environments. Okay. We are fundamentally a small data environment. And I think the last point I'd make is that we need to recognize in this evolution-revolution question, what is the what is the starting point, right? When we start using ML in asset management, we're not starting from ground zero. We have a model in place. We have maybe a linear model, but it's a good model, right? You might have a couple dozen or a couple hundred signals. You're using them in fairly simple ways, linear. That has attractive features. It's robust. It's transparent. But you also have to recognize that a linear model is, going back to my talk this morning, that's the first order approximation. The first order approximation is the important one. The second order one can be incremental. It can have alpha relative to the first, but it's probably not going to be as big as the first. Third order, a little bit less. Fourth order, less so. So I think this is important just in terms of building expectations about what machine learning can do in asset management. Incremental, evolutionary. It's not the pitch you get from, I think, a lot of people that are in the business, but I think that's the reality as I would present it.
Sven, would you give another answer from a private equity point of view, or?
Yeah, I think Roy and Mara said we tend to overestimate the impact of technology and in the short term and underestimate it in the long term. So I think there's a time perspective. But I do agree. But I think in private markets, especially venture capital, that's millions of startups are coming online every year, right? And they spew data. It's very rich. It's very dense. It's just hard to capture those signals. I think actually one of the biggest problems we've been facing is adoption and investment professionals adopting these tools and doing things differently. So that's that. But everything else is sort of coming together now. We've got data. We've got a low-cost technology to actually analyze that. The talent market is developing. So I think there are parts of the market where it'll be revolutionary, and parts of the market where it's more evolutionary. Real estate data, you can do so much, right? Combining demographics data, looking at what kind of people are moving into any given area, and what that will, what will happen to rentals over, the next 10 years. You can do a lot, right? Applying machine learning technologies can have massive impact on some in some categories and less so in others.
Okay. Do I see any hands? You don't have to ask a question. You can have views. You can sort of differ with what's being said from. Please.
Yes, thank you, Urban Fundred. I'm from the Swedish Securities Markets Association. I think early this morning I had this fear of HAL 9000 taking over, from the humans. But it seems from, what you've all been saying, that humans still have a very important role to play here. Be it taking over, from the autopilot when the plane is about to crash, or just checking the models, etc. But in the long term, where do you think, will there still be room for the kind of more normal human trader, etc., or will all traders and asset managers be more or less robots?
Will we see algos compete or human beings compete? Svante?
If you look at our trading desk nowadays, we still have traders 24 hours a day, but they do a very different thing compared to what they did 20 years back, right? So they overview and overlook the process, make sure that we are connected to all the exchanges and so on. But we have the algos that trade. But I don't expect to have an environment where we don't have any traders in place, but they will have new things to do and do things in a different way. Same thing with the ML algos that we use. The financial markets have always changed over time. They will continue to change. We will need to adjust the models, and there will be plenty of things to do for our research team, I'm pretty sure.
Anybody else?
Yeah, I'd add to that. So coming back to this small data point, right? One fundamental fact, just statistical understanding of how we approach models and how humans play a role in those models. Data and structure are substitutes. When you have a lot of data, you don't need structure from a human. But when you're in a small data environment, any structure that you can inject, wherever it comes from, it could come from logic, intuition, it could come from a theoretical model, any structure you can inject, it takes pressure off of the data, right? I mean, I like to think about data as a resource allocation problem, right? I have a certain number of observations I can learn from. To the extent that I can supplement my model with some theory, well, then I get to use those observations and spend them elsewhere to learn something else that I don't know, right? So to the extent, this is not about the trader, this is about the researcher, right? To the extent that we can have humans that can understand economic mechanisms and build those into models that can be complemented with learning about things that the humans don't understand via the data, that's a great opportunity. That's never going to go away in the asset management industry.
Okay, yes.
So, of course, all these new tools are as useful as Brian was saying. The more data you have, the more of an advantage you can take from these tools. And so my question is, how much investment you think you've put in the gathering of data, and how much of that you do internally versus outsourcing your data gathering, and how much of a strive is there on like proprietary data relative to your investment in the tools?
Who would like to?
Katie?
I can start. I think the challenge is depending on what your use case is. So in our space, we're trading global futures. So it is actually very difficult to find the data that will give you a better predictive value than something else. Whereas it's really exciting as you move farther down the curve, there's more and more opportunities to use data. So, for example, as you move even into agricultural commodities, there's more data out there that might be useful for a more idiosyncratic market. And that actually continues down the spread to private equity, where suddenly there's this data that not everybody has, that has some information that you can process. So from my perspective, it's your use case that matters in terms of what data will actually help you, and it's measuring things with that data that is where the advantage comes from these techniques.
Somebody else?
I'll go. I think the way we look at it, it's decision intelligence, right? So and also touching on the question before, it's very much in the private equities market a people game still. You can't do it. You will never see, or at least I can't envision a world where robots will be doing the trades. We look at this in two ways, right? We're making investments in data and technology and building a tool, which is Motherbrain. But we're also building a capability that goes much further, which is something different, right? And I think you can call it decision intelligence, you can call it augmented investing, if you will. What we do is to accelerate decision making, to walk away from this deal because you don't need to spend 3 weeks on this because data upfront will tell you it's not worth it, right? Or, wow, this looks really promising. Can we accelerate our conviction here by applying data science, advanced analytics, or machine learning? Yes, boom. And then then you double down and you accelerate all those decision and budget approvals, what have you, in order to get to the right, spend your time wisely. That's one big part of what we're trying to achieve. And in that game, you can't really outsource it. We've made the call that we need to build this this capability internally, right? And that there's no, we haven't found any shortcuts. So we buy a lot of data, we produce a lot of data, and we have a big team.
Okay. It's so dark. It looks like a nightclub. It's hard to. I think it was Hans Wallin and Erik. Okay, Hans, please.
Yeah, so I would like to comment to something Svante said that really hit home for me. So I think one of the most difficult situations if you're managing like a large quantitative investment operation is when the models are not doing well, right? You have to explain to the board or to your CEO or whatever, like, this is why things are not working. And you said, the challenge with your ML models is that you can't really explain very well. And when they get more complex, it's even more difficult to explain. So from an organizational behavior point of view, I think it's a question. I will go for Brian first because you're like the complexity man here in this meeting. But maybe Katie, you also want to comment that. I mean, I think that sounds like a very challenging situation, and also like objectively, how do you judge? Is this the model, not working right now because there's a problem, or is it, fundamentally now misspecified? It hasn't adapted to the world. How do you judge that in that situation?
Yeah, so this is a great question, and I hear this one a lot. So I think the interesting thing to keep in mind is that we have to have some perspective on what it means to be interpretable or to understand a model, right? When we have fluctuations in asset markets, we don't understand where those come from, right? Asset pricing theory doesn't understand it. Financial market participants don't understand it, all right? We may give some sort of local explanations for why things happen. That's very different from understanding what's going on, right? So suppose I have a trend signal in my model, and I lost some money, and I can track it back to a trend signal. Do I understand why I lost money? I might be able to explain to an investor that I lost money because this particular trend signal didn't do what I hoped it would do. But I would say that that's an extremely shallow explanation. So when I think about the potential loss of interpretability from moving to complex models, I feel like we're sacrificing a lot less than we might make it sound, right? Because we have these situations where we have the ability to expand a model and improve our predictions, improve our performance on average. I might not be able to explain where that's coming from, but if I can believe that I've built a model that has reason to be more predictive, for example, for some of the complexity arguments that I gave, and it realizes on average to be more predictive, I'm going to lose money sometimes. Markets are risky, right? And I'm going to be willing to take those bets even if I don't have a clear interpretability. So, I mean, in terms of, I think this is also closely related to the evolution versus revolution point. Where I see really the evolution coming from in the next 3-5 years in the asset management industry, is I actually see a softening up in this perspective of what flexible models can do for us, right? This idea that maybe we didn't have such a great interpretation of what they were doing already, and this gain, even if it's a relatively smaller incremental gain from having more flexibility in our models, maybe it's not costing us all that much in terms of interpretability.
Katie?
So I would have to say that from our perspective, we've seen a shift in the industry. People have asked for you to be very transparent. We go into pension funds and we show them our machine learning models and we explain exactly how they work, and we try to maintain some structure so that they understand. We create reports and things that explain our models are speeding up or slowing down, and we have to be accountable for them. The reason is that we're seeing that, if you're working with pension funds who are managing money for teachers and governments, there's a reason why they need to understand exactly why they made money and lost money. And yes, we want to use those techniques, but we have to, at the end of the day, we need to be able to explain that. And that's why our space is actually bifurcated, in that there are people who are much more pure in their approach, and some of the pension funds have really appreciated that in the sense that they want to understand exactly. They'd rather know exactly how you do that so that when things don't work, they understand why. And so I'd say that that's why the evolution is so important, because at the end of the day, if you're down an extra 10% on a pension fund's account, that's a really hard thing to explain. So from my experience, it's much more about being consistent, like the models I showed you there, where you can understand, versus the trade-off of sort of that little incremental Sharpe ratio that may or may not be there looking forward.
Svante?
Yeah, I agree with Katie, and I think the big challenge is really the time frame of our clients in the industry, because if you look at trend following that we work with, most of the time you're in a drawdown. So now we are lucky, we have a fantastic year, but normally like 80% of the time we are in a drawdown. And people will question, does trend following really work anymore, or has market changed, or and the clients, their time frame is normally a bit too short. We need to educate them all the time and to explain, why you have to have a time frame of maybe 5 or 7 years, and why we don't deliver in some market environments. So it's a really education game and a confidence game, both for us when we look at our models, but also from the client side. It's easy to invest in something that has had drawdown historically, but then after 3 months you will call your manager and ask, I know that you're not making money, what's happening really? So it's tough.
Okay, we have 6 more minutes, and I've seen 3 hands in the air. Let's do it like this. We take those 3 questions as short as possible, and then we give them to the panel. Erik Tidén, you're first.
Thank you. Very good presentations. I just want to kind of bring up another aspect of this, and that's financial stability. Would you think, and maybe this is especially to Svante and to Kathryn, that this will kind of increase the risk of herd behavior, so that if you get many of funds like you run, that in a potential crash of the markets, that will actually cannot be pushed even further by your strategies, and hence it could be a concern for people like me. Thanks.
Okay, is herd behavior more likely? Yes, you're next to each other. You sort this out.
Okay, thanks. What is your opinion about academic research? Is it too simple, too naive? Short example, we collect data on Twitter and financial data, we combine it, and we think we have a good paper. But if you compare it to Mother Brain, then it's not even 1% what you are doing. So are we too naive, too simple?
Okay.
Last but not least, my name is Giovanni Begliossi. My background is in quant management. I've seen the space wobble, to put it mildly. Personally, 98, 2007, 2008, and more recently. Part of that wobbling, certainly in 2008, was due to the fact that some of the models being used were the same. I would argue the risk models were the same. What do you expect to happen when AI becomes dominant? We've seen an effort now in a major SWF in the world to implement very large-scale programs based on AI. We're talking about $1 trillion sized. So what do you expect to happen? Are we prone to the same sort of things happening, or this time it's going to be different?
Okay, so herd behavior and oversimplistic models or something like it. Who wants to go first?
I think I can start with the models.
Please.
So I think and going to the herding point as well, I think we talk a lot more in the US about simple models, and passive investing is actually active investing with simple models. And we have more and more of those type of rules in the way that people invest in every aspect of our business. So I think the herding issue and sort of the issue of potentially having cascades in prices is a real issue, because the way that we trade today is a little different than the way that we traded before. And so I think that's something we think about, but we trade only in the most highly liquid markets, which is very, very deep. So I think the biggest joke we have in our industry is reporters will always call us and say, did you move the S&P? And I usually laugh because I say, there's no way. So in certain markets where you have enough liquidity and they're large enough, sort of simple, complex models like we're using, they're not as detectable as, say, simple rules. So I'm actually more worried about simple rules than I am about complex ones.
Okay, Brian?
Maybe I can take the academia question. So I think we need to recognize what academic research is, which is, trying to make some progress on difficult questions, given the resources that we have at our disposal. And academic research has made some extraordinary strides in these questions, and then other times it attacks problems from very naive perspectives as well. I mean, the number of papers that are written that are agnostic to real-world frictions like trading costs are through the roof, right? But that's just one aspect of what finance research is trying to accomplish. So I would kind of try and tie that to some of these earlier comments that were coming off Simona's question and the other question as well about, what is the role of humans in the future research process in asset management. And I think doing things like trying to better understand what these more sophisticated models are doing, that's, again, a human role that's not going to go away. So in some sense, thinking about how do we actually solve problems like interpretability, those are jobs for humans, right? So in any case.
So,
Yeah, I'll build on that. So again, I think it's about augmented investing, right? In our industry, certainly the private markets, there's a lot of art still, and that will remain. You might be presented with a host of opportunities, but if you don't have people who are convincing and can put you in a position to actually take action on those opportunities, there's zero value produced. In terms of the models and the complexity, it's quite remarkable if you look behind if you dive into these algorithms and what they can do, right? So the ultimate score I mentioned in my presentation is it's rarely super indicative. You have to go in, and if it's a B2B company, there's a lot less signals, right? Because people don't tweet about the great example of whatever the software tool they were using, or there's a lot less buzz around it. So you have to look at other factors, and it's all relative, right? So you have to look at it. Some categories are just, there's more noise and there are more signals because people are more engaged in it, and so you have to factor in that. So only then does this produce value. But again, for us, decision intelligence is, I think, the word I want to lead with, because what it helps us is to make apply humans where humans should be applied, and machine learning where that applies, right? So that's how I would sum it up.
Svante, you get the last word.
Okay, so I'll take Eric's question regarding if we are a threat to the system. If you look historically on hedge funds in general, yes, there have been a few cases, but I'm not concerned about our small part of the hedge fund industry, because what we do is directional. So we buy when things go up, we sell when things go down. What you historically have seen is that it's the funds that work with arbitrage, going long and short, making spreads and that type of, where you build up huge leverage positions. That's where you can have the problem. But as Katie said, we trade very liquid markets. We will not be your problem, I promise.
You're brave, something.
That was a promise. We have run out of time. I think that was a great discussion. I enjoyed it very much. Katie, Brian, Sven, Svante, thank you so much. And so I leave the word to Niklas Ekvall, Chairman of the Board of the Swedish House of Finance and also CEO of AP4. Please.
Thank you, Pehr. And wow, what a spectacular day, and well-organized day, and many thought-provoking discussions and presentations during the day. And yeah, I'm always amazed when I are at events like this, when we have a mix of practitioners and academics, for many reasons. One is how close the distance is between the research conducted at universities and what the practitioners are doing out in the financial industry, and how fast research results are implemented into the industry. I can't hardly think of any sector or industry where this closeness is so close, like in the financial industry, and that always amazes me when I'm at occasions like this one. And another reflection from the discussions today is, as always, when you discuss AI, big data, machine learning, how fast the development is, and what type of impact it has on industries like the financial industry, but also the society overall. And today, I don't believe there are any financial organization that is not working with AI, machine learning in one way or another. As a small example, I work at an institutional investors like AP4, and we put quite a lot of efforts in our internal work and try to understand how we can use AI machine learning to improve our investment decisions and investment process. But we spend even more time in trying to understand how AI machine learning might create new businesses, might impact value chains and the companies we invest into. And also on the macro level, the potential for AI machine learning to give productivity gains and actually increasing the economic growth overall. So there are a lot of things to think about when we talk about AI machine learning, and has been a great day and a lot of good discussions and reflections regarding that. And of course, there have been very many persons involved in organizing a successful day like this one. In particular, I would like to extend a great thank you to the Swedish Securities Markets Association for providing funding for. Without that funding, this day wouldn't have been possible. Then, of course, we also have some persons that have worked, or many persons have worked to organize this day, but in particular, Professor Alexander Törnkvist. I don't know where you are. There you are. and he has been responsible for planning and organizing this day together with his colleagues, Ricardo Tuki and Yi Shang, and they have done a tremendous work, as you can see. It's not only today, it's also a day tomorrow, which has a little bit more academic touch. Yeah. So a great thank you to you, Alexander, and your colleagues. Then, of course, we have had a lot of great speakers today, and a great thank you to all of you that have contributed with your thoughts and research and ideas and discussions there. So, and you come from almost all over the world to come here to Stockholm and have presentation discussions. A big thank you to all your speakers. And lastly, and not the least, a big thank you to all of you sitting in this room. And all the good questions, the energy and dynamic environment we have in here. So big thank you to the audience. Without you, it wouldn't have been this successful day either. So with that, as a closing remark, it might be so that we should give the Swedish Securities Markets Association, the speakers, Alexander and his team, and not the least all of you and ourselves, a big hand to end this day.